For many years, moving to Portugal was sold as a brilliant financial cheat code. Pack your bags, rent an apartment in the heart of Lisbon, and enjoy a flat 10% tax rate on foreign income. Today, that relaxed coastal dream has been completely replaced by a rigid digital grid of absolute tax compliance. The famous non-habitual resident program, the NHR, is dead. Anyone arriving in 2026 or later is entirely locked out of those broad, generalized tax exemptions. The vocal tax system has bifurcated. New arrivals face either a steeply progressive standard tax scale, or they must qualify for a strict, highly targeted exemption regime known as IFICI. Simultaneously, the United States overhauled its domestic tax code. The One Big Beautiful Bill Act rewrote how the IRS taxes money earned and transferred overseas. Because the U.S. enforces citizenship-based taxation, crossing the Atlantic does not sever your tax obligations. You still have to file Form 1040 every year, no matter where you currently live. Surviving this new landscape requires mathematical precision. A single misstep in your paperwork will trigger double taxation from both governments. The era of casual relocation is entirely over. If you enter Portugal as a standard tax resident, you face a fiscal system designed to extract revenue from high-earning professionals. The progressive tax brackets here climb rapidly. Long before your income reaches six figures, you are pushed into the upper tiers of liability. This chart shows the 2026 Portuguese income tax brackets. Once your taxable income crosses €86,634, your marginal rate hits 48%, and that does not include the additional solidarity surcharges of up to 5% levied on top of that. The government built exactly one alternative, the Incentive for Scientific Research and Innovation, or IFICI. Qualifying for this regime drops your rate on Portuguese-source income to a flat 20% for 10 years. But the barrier to entry is high. The status is entirely activity-driven. You must be employed in a specifically recognized high-value sector, like deep tech, academic research, or a state-certified startup. Retirees are explicitly excluded from IFICI. If you move to the Algarve in 2026 to live on your U.S. pension or Social Security, those distributions are subjected to the standard 48% progressive rates. Portugal is now calculating your exact utility to its economy. Bring highly qualified labor, and you receive a discount. Bring passive retirement income, and you pay the maximum fiscal penalty. Paying local taxes in Lisbon is only half the equation. You still have to defend that income against the IRS. Expats typically use one of two defense mechanisms: the Foreign Earned Income Exclusion, which wipes a specific amount of income off your U.S. return, or the Foreign Tax Credit, which applies the taxes you paid in Portugal against your U.S. bill. The OBBBA introduced a permanent $2,200 child tax credit, but it created a strict mathematical conflict for expats with families. This logic flow visualizes the problem. If you take the Foreign Earned Income Exclusion path, you zero out your earned income on paper. Without earned income on your return, the system inadvertently disqualifies you from claiming the refundable portion of that credit. The optimized strategy for 2026 relies on the foreign tax credit. Because Portuguese tax rates are higher than U.S. rates, the credit completely wipes out your U.S. liability, but crucially, it preserves the earned income on your return, allowing you to legally claim that $2,200 refund from the IRS. The OBBBA also targets the movement of your money. There is a new 1% international remittance tax on funds sent using physical instruments like cash. You bypass this entirely by using fully electronic bank-to-bank transfers. Strategic federal filing now targets the extraction of permanent government credits, moving past the baseline requirement of avoiding double taxation. High earners fleeing aggressive tax jurisdictions like California face a secondary threat at the state level. Boarding a flight to Europe does not automatically sever your legal domicile in the eyes of the Franchise Tax Board. If they believe you intend to return, they will continue to tax your worldwide income. Your primary legal defense is the FTB 546-day safe harbor rule. If you leave the state under an employment contract for an uninterrupted period of 546 days, California treats you as a non-resident. This ledger visualizes the hidden tripwire in that rule. If your investments generate more than $200,000 in intangible income, like capital gains or dividends, in a single taxable year, it instantly voids the safe harbor protection. Tech workers face a specific hazard under FTB Publication 1004, which governs unvested restricted stock units. If your RSUs were granted in California but vest while you are living in Portugal, California still taxes that income. They calculate their cut based on the number of days you worked in the state prior to your move. Escaping state taxes requires a clinical ledger analysis before you leave. State tax boards ruthlessly audit any remaining financial tethers you leave behind. For expats seeking maximum flexibility, the Golden Visa requires just 7 days of presence per year, accessed by investing 500,000 euros into Portuguese investment funds. But those funds hide a massive compliance trap. The IRS classifies almost all of them as passive foreign investment companies, or PFICs. If you buy into one of these funds and fail to file specific tax elections in your first year, the IRS defaults you into the punitive Section 1291 regime. This line chart maps out the mathematical penalty. The IRS assumes you have been maliciously deferring taxes on that foreign fund. When you sell, they apply the maximum 37% tax rate to your gains. Worse, that 37% rate is retroactively applied to every single year you held the fund. Then, they add compounding interest charges dating back to the moment the tax would have been due. The gold standard solution to avoid this is filing a Qualified Electing Fund, or QEF, election. A QEF election makes you pay tax on your pro rata share of the fund's earnings every year, successfully preserving your standard capital gains rates. But there is a catch. You can only make this election if the Portuguese fund is willing to provide you with a highly specific PFIC annual information statement. If the fund refuses to cooperate, you have to trigger the backup plan, the mark-to-market election under Section 1296. This forces you to treat the fund as if you sold and repurchased it every single year. You pay the 37% ordinary tax rate on the unrealized gains, but it successfully stops the compounding interest death spiral. Buying a Golden Visa without pre-clearing your PFIC reporting strategy is financial suicide. It turns a residency asset into an inescapable IRS liability. Zooming out, a successful relocation to Portugal in 2026 relies on executing a precise architectural blueprint. First, you must align your professional output with IFCI's high-value sectors to secure the 20% flat rate, avoiding the 48% progressive trap. Second, keep your primary investments in U.S. domiciled brokerage accounts. Buying U.S. ETFs entirely bypasses the PIFIC reporting nightmare. Third, bypass the strained public healthcare system. Secure private insurance with a minimum of 30,000 euros in coverage to satisfy visa requirements and ensure access to specialists. Fourth, remit your living expenses using digital transfer platforms to sidestep the OBBBA 1% excise tax on physical instruments. Finally, document a careful severance of your state ties before you leave. Secure new licenses and registrations to lock out aggressive auditors from places like California. Portugal in 2026 remains a highly lucrative jurisdiction. But surviving here requires discarding the myth of the frictionless tax haven and replacing it with rigorous, uncompromising legal execution.